What is happening, people? It is your boy Jack, and today we're coming back at you with another video. And today we're going to be speaking about and going into depth on what the S&P 500 Index Fund, ticker symbol VOO, actually is and why it is so important to investors like me. But right before we get into that juicy stuff, I'm going to ask you please to smash the like button on this video. It helps me out massively. Drop me a comment, let me know what stocks you're currently looking at or you are invested in, and subscribe and hit that bell button so that you never miss a video in the future. But let's get straight into it. So now I am nice and small in the corner and we can get into the juicy stuff. So the S&P 500 and how it works, okay? So let's just go into the very basics. This first line is all we need. The S&P 500 is a stock market index that tracks the stocks of 500 large cap US companies. So what that means is it's one stock that you can go and purchase one share in, and you're actually purchasing 500 of the biggest US stocks that are out there. Now a lot of people just invest in this one stock, so in the S&P 500 they just invest in this one stock, and that is diversifying their portfolio massively because they're actually investing in over 500 of the biggest US companies that are out there currently. But to somebody like me who chooses individual stocks, chooses what companies we like to invest in by ourselves, we do our own analysis, we buy the ones that we want and we believe in. We don't want to buy 500 at once. Why is this still so important to us? Well, it gives us something to compare our portfolios to, and it basically gives a broad sense of how the market as a whole is doing. If the S&P is doing well or poorly, more than likely your portfolio will do well or poorly, and it gives us something to compare how we are doing against. Reason being is it's so diversified. As we just said, there's 500 individual companies inside of this one index fund. So if we can understand how 500 of the biggest US companies are doing, if they're performing well or poorly, that's going to give us a very good idea of how the market as a whole is doing, because these are the biggest companies out there. These are the leaders. It doesn't matter if a few of them are doing really well or really poorly. It gives us a broader idea of the entire market. This is how the S&P 500 is currently split up in where its investments lie. They have 24.4% in information technology, 14% in healthcare. It goes the whole way down financials. They're in all of the main 11 sectors that are in the stock market. So again, it's as diversified as it possibly can be. Yes, they have a lot more money in certain things like information technology and healthcare as opposed to materials and real estate, but they are involved in every single sector. Now we're going to have a quick look on SimpliSafe dividends, just to see how literally any company you ever look up, there will be a comparison made to how the S&P 500 performed during the recession. That is something that we always look at when we're trying to decide what companies we want to invest in long term, especially if you're a relatively safe investor. If you want to invest in companies that perform well, not only when the market's doing well, but when times get tough. If you want to choose companies that have in the past outperformed the market in the hard times, it's a really important statistic for us to have. So if we go have a look at Disney, for example, we can see the S&P 500 lost 55% from its peak between 2007 and 2009. So during the Great Recession, okay, it dropped 55%. Disney wasn't all that different, and they actually dropped exactly 55% as well. So you can see that you can expect Disney to perform as well or as poorly in general as the market as a whole. So if the market's doing well, you will expect this company to be doing well, and vice versa. If it's doing poorly, you will expect this company to be doing poorly. Now this is important when we choose what stocks we want to invest in. Obviously, we want to see the companies that we decide to invest in do well or the same as the broader market when times get tough. Generally, we don't want to see them as performing worse than the S&P 500 during the Great Recession. It's kind of a telltale sign that, okay, this company isn't very good at handling the tough times, which is one thing we have to factor in when deciding what we want our long-term investments to be. Now we're going to do the same thing, but with McDonald's, a company that I actually opened a position in last Friday. So we can see here again, obviously now we know the S&P lost 55% between 2007 and 2009. McDonald's significantly outperformed the market during the Great Recession and returned -3%, which suggests it could be a more defensive investment. So it suggests that even when times get tough, McDonald's may be able to perform relatively well or a lot better compared to the broader market. Again, whenever we want to invest in something, the more information we have, the more comparisons we can make, and lets us make more informed decisions. The S&P 500 is one that you are always going to be using when deciding what stocks to invest in. Now we're going to have a quick look at their charts going back as far as 1980, where we see they were sitting at $100 a share, and we can see the growth. And where we're really interested in looking, right, is where we peak in 2007 and then the dip that preceded. So this was that 55% dip that we just spoke about in the last clip, and we can see since then the market has been on such a bull run for almost 10 years. For over 10 years we've been on a bull run, and then boom, an unprecedented spike like we have never seen before. We can see it was up 3,200 points and now we're down to 2,300 points, just over. It took a nice little shoot up today, but you get the picture. I just want to say quickly, just have a look at the spike we have seen here. Look, during the entirety of the Great Depression, There is not a spike like this. We've never seen anything like this before. We're all going through something that is going to be speaking about for decades and decades and probably centuries to come. So just, if you're in the market, give yourself a little pat on the back, because you're going through this, you're going to survive it. You're going to be able to tell your great grandkids about this in the decades to come. It's crazy. But again, let's just reiterate the point. This gives us an idea of how the market as a whole has moved over time since 1980. And it has, for the most part, been up and up and up. Obviously, we have our dips, we have our prolonged dips, but ultimately it's always bounced up. And this is the lowest it's been since pretty much 2018-ish. Well, it's actually lower than it hit in 2018, but you get the picture. It hasn't been this low in a long time. The market hasn't been this cheap in a long time. Something of note, it has a dividend yield of 2.44%. If you know me, you know I'm primarily a dividend investor. So this is nice. Obviously, it's not the highest yield in the world, but it is one of the safest investments you can make. It is generally believed that this is one of the safest stocks that you can invest in, because again, it covers such a broad proportion of the market. So investing in the Vanguard S&P 500 is pretty much the exact opposite of putting all of your money in one stock over here. So investing in 500 companies versus investing in one. Yes, this here is going to be more steady. The odds of it going up are higher. They may not see the same return, but they almost definitely in the long term won't lose you money. Whereas putting your money all in one stock here, anything could happen. It could give you the biggest return we've ever seen. You could be rich off of one stock, or you could lose absolutely everything off of one stock. So for safer investors, for people who want to put their money away for a long time, who don't want to do the research, who don't want to choose individual stocks, this is an awesome company. If you're a really emotional investor, if you're afraid of, you know, one stock losing you a lot of money, then this is going to be better for you. Whereas if you want to go out and choose your own stocks and you are risk tolerant enough to not just put them all in one basket like me, I choose my own stocks, but I still am invested in over 20 currently and want to get that up over 50 or so as the months go on, it may not be the absolute best choice for you. It all depends on what kind of investor you are. And just something that's quite cool to look at is they have a market cap of 433 billion. That is a big market cap. Now we're going to have a look at the S&P 500's PE ratio, which is their price to earnings ratio. Generally, a PE ratio we look for that is to be considered average is 14. Anything above that's a little high, and anything below that is a little low. Now, right now we're sitting at 17.78, and we can see we actually haven't been that low in how long? 17.78, boom, pretty much all the way back to 2013. So it is very low. Their PE ratio is the lowest it's been in pretty much 7 years, 6.5 years. This to us as investors mean that people may be becoming somewhat pessimistic of them going up in the months to come, which is completely understandable because of the virus that's going on and everything that's happened in the world, the Fed cutting rates, basically America printing unlimited money, everything that's going on. It's understandable why this would be the lowest it's been in so long, even though it is still above the industry average that we would look for when investing in a company. So the fact it is at more than a 5-year low, their PE ratio, does show us that it is quite a good buy as of right now. But again, we can see that people are pessimistic about this, as they are with the market as a whole right now, so it definitely has room to go a little bit lower. Now, I've spoken about the fact that this is one stock that you can buy that consists of over 500 companies, so let's just have a look at some of the massive names in there. Microsoft Corp, Apple, Amazon, Facebook, Berkshire Hathaway, Google, Johnson & Johnson, JP Morgan, Procter & Gamble, and the list goes on and on for literally all 500 of them. Even when you get down low, there's T-Mobile, Public Storage, Kroger, ones that everybody knows. So it is truly all of the biggest companies in the US. So guys, hopefully you were able to take something from that video. Essentially, us long-term investors just use the S&P 500 as something to compare our stock picks against. If you did get anything out of this video and you did enjoy it, again, please do smash the like button, subscribe so that you never miss a video. And until the next one, guys, once more, peace.